right, our next guest is the street's biggest Apple bear. His price target is $120 a share, and he has one of the only sell ratings on it on the street. Walter Piecyk is with Lightshed Partners. Walter, great to have you with us.
Thanks, Melissa. How are you doing?
Good. Is it tough to have this rating, this price target on Apple, seeming juggernaut in this market? I mean, some would argue that in spite of these headwinds today, the stock actually acted pretty well.
I mean, it's definitely been tough. We've had a sell since March. The stock's up 20%, outperforming the S&P, but underperforming the triple Q. So, you know, the issue, though, is, I think, as you guys were talking about, it's not growing. The company is not growing, and the multiple just went from, over that period, from 25 to 30 over the past 4 years, from 15 to 30 for a no-growth company. They're showing some minimal earnings growth because they're buying stock back. So then the question is, okay, that's already happened. That's the last 3 quarters. What about next year? Maybe people are expecting them to return to growth next year. And look, the single primary driver of this company's revenue and profit growth is still the iPhone. It's 52% of revenue. Right. So, and what's happening today? Earlier on CNBC, you had the CEO of AT&T tell David Faber that people are just holding onto their phones longer. I was listening to you guys before. You're 100% right. No one's going to get rid of their iPhone. The question is, how long is it going to take them to upgrade to the next model? And we all know the battery dies, but the battery's been getting better. And what is it about this year that's going to get you to buy it? Is it a higher price? Is that going to inspire you to buy the phone faster? Because the telcos, which is where all the product goes through, these are the guys that are doing the promotions. Mike Sievert also on CNBC talking about promotions, you know, costing more and then wanting to pull back on that. Like, what's going to make you buy your iPhone or replace your iPhone faster than you did before? That's the question. And
what is the most likely trigger for this decline that you see to 120? Is it, I mean, you can argue that if the market overall goes down, Apple still remains higher relative to the markets, and if the markets go higher, it's because of Apple. It's sort of a lose-lose situation for you bears out there.
Yeah, I mean, I certainly, again, didn't expect multiple expansion when they missed the quarter and generated a nickel off of a lower tax rate, right? You don't expect that to happen, but going forward, you know, I did this back in 2012, same issue with the operators, and we were wrong early on, and then it kicked in where the replacement cycle extended, the stock missed, and they had one of these drawdowns that you guys were referring to earlier. So why do stocks go down, or why do multiples contract? When companies miss earnings. And yeah, you could say it didn't happen last quarter, but if they miss earnings next quarter, or if the street's expecting 3 to 5% growth next year and it's not 3 to 5% growth, then at some point investors look at other large cap names that are out there and say maybe we should be in those names rather than Apple. And that's theoretically how the call can work. But you're right. Up to this point, it's been painful and it's not worked, even though they've missed earnings, or at least and not delivered any type of growth in recent quarters.
Walter, it's interesting, and you probably know the number exactly, but I think Apple's in about 350-ish ETFs, of which it's in the top 15 holdings. So in the world of passive investing, where nothing matters but money flow, Apple wins to that, and they're probably the biggest winner. So part of your thesis, I would imagine at 120, is something happens in the broader market as well. Is that accurate?
I mean, look, I'm cognizant. I'm not going to be the macro guy making that call. It's certainly been surprising what the market has done this year relative to all of the things that are going on. So I'm aware of that. But as a fundamental analyst, if I look, we've had a neutral on this before. I've had a buy on this more than I've had a sell on it by a large stretch. But if I look at a company and I look at their valuation, I look at the free cash flow yield, I look at PEG ratios, and I look at my numbers being next year $17 billion lower than consensus in revenue. If that happens, and I'm right fundamentally, then theoretically the market should reflect that. And I get that there's large companies that are driving the market, but when they reported last quarter, the stock was down and the market was up. So you do have leadership that obviously benefits from inflows, but sometimes leadership changes, or the weighting within those large companies does change if there's other companies. By the way, there's analysts out there saying, like, hey, this should get a services multiple. Services multiple, Netflix PE multiple is lower than Apple. So it's not like if it becomes a services company, that's going to re-rate to a higher number. That's a lower number right now.